And then we have with us also John Hogberg, who's a partner in the Grant Thornton Tax Reporting Advisory Practice. He has over 17 years of experience, primarily serving clients in the Midwest. John's areas of specialization includes providing tax service for multinational corporations, including private equity-backed corporations, ASC 740 audit support and internal controls, tax provision preparation, tax compliance engagements, and advising on the purchase accounting treatment of M&A. Wow, I'm amongst the greats here today. This is awesome. We have Damian Martin with us as well. Damian's a tax partner with BKD and provides tax compliance consulting and planning service to individuals, families, and fiduciaries, and provides proactive succession planning for high net worth individuals and their family-owned businesses as the East Region leader of the BKD Private Client Group. He's also the host of Simply Tax. So he's going to have to tell me how I did today, if I am worthy of a podcast myself. We'll see. But he's the host of Simply Tax, which is a podcast dedicated to delivering practical and timely content to simplify tax challenges. So Damian, let me tell you something. One day I want to be in that group of high net worth individuals so that I need you, right?
There you
That's
go.
my goal.
Yeah. Well, great. Well, thanks for having me
goals.
Here. Happy to be here. Yeah.
That's right. Mark Smetana, he is with us as well. And Mark is one of our own FEI members here. So it's exciting to have him represent us for many reasons that you'll hear about in a moment. But she's CFO of E.B. Brown Company, who is a wholesale distributor of broadline products to the convenience store industry. We've all seen their products, right? Mark led in the transition of that longtime family-owned business with a strategic partner, a new ownership. He's an FEI member and a Chicago chapter board member. He serves on FEI's national board and has testified before the Ways and Means Committee on tax reform for closely held business and has provided expertise on many, many panels. So this is the group that's going to guide us through some of what's going on today. It's pretty exciting because this is more timely than we all, can appreciate, that I'm sure we can all appreciate. It's relevant, it's timely, and it's happening now. And I think one of the things that is really important to realize is it's not done, right? This is sort of emerging and evolving. We have to stay close to it. And so those of us who are attending today are here because we know that our businesses are counting on us to stay close to it and counting on us to make plans for how they're going to navigate these issues going forward. So today, what we hope to leave you with is an idea of the kinds of things you should be paying attention to, taking stock of, and bringing back into your organizations for planning purposes. So with that, we're going to get started. I would love it if you would chime in at any given moment when you have things that you may want to talk about. You are free to do that. We welcome it. Put your comments in the chat and we will acknowledge them there. So to get us started, we're going to share with you a few of the things that we're going to be talking about today, just some of the major tax areas that we're going to cover around corporate, international, partnerships and pass-through entities, some personal things. Some of us are going to be affected by this as well. Some more than others, but we will be affected by it. Some planning considerations. And then the thing that Mark is very, very passionate about and has done a great deal of work on behalf of FEI chapter is on advocacy and things that we can also do to help support this regulation and where we'd like to see things fall. So we're going to make sure he has some time to talk about some of that work as well. So Mark, we're going to start with you. I would love it if you could help our group understand in a bird's eye view. It's hard to do in a bird's eye view, and I know that's true. What's going on exactly? Tell us a little bit about these regulations that are on the way down the pipe.
Well, sure thing. Thanks, Sherry. I think we'll kind of cover this overview kind of quickly, but just to kind of set the table, kind of what's going on, what are we hearing about the news? We got reconciliation, bipartisan, we got taxes, we got spending. So what's going on, and I guess I'll separate this, cause a little dichotomy from the last big tax bill we had, which was the 2017 reform in the last administration and Congress. That was a pure tax bill that got passed. This time we actually have a pretty significant tax bill embedded in a overall broad spending agenda bill. The bill, it's been called the Build Basic Better Plan. It's got a bunch of priorities, cover some of the high views in a minute. In addition to the Build Basic Better Plan, there's also been kind of a corollary plan that's been going through Congress, which is a bipartisan infrastructure plan, which we would generally think about roads and bridges and kind of hard assets construction stuff, which is bipartisan support and would pass on its own if it went all the way through the process. The Build Basic Better Plan cannot, in its current form, pass through kind of normal order process because there simply isn't a majority in the Senate that has agreed to this plan in its current construct. So the majority party is currently going through a process to try to run it through and what they call reconciliation process, which is real specialized rules in the Congress. You could do it once or twice at Congress. The main thing, though, it has to be paid for. And if it's paid for over a 10-year basis, you can get it passed with just a simple majority in the Senate, and you kind of mostly avoid all the filibuster and the supermajority rules that are required for most every other bill to go through. This thing is by no means kind of set in stone. In fact, there's daily changes, daily communication coming out and leaks to the press. It's still, I would say, a long way from being final. But we do have, and Sherry, if you could move to the next slide, we do have a pretty good glimpse as to where it's heading, at least in terms of some of the tax principles. And that was via a Ways and Means bill that came out about the end of September. While the details haven't been publicly released, all the bills that go through a budget process and tax bills have to get scored by an independent committee at Congress called the Joint Committee of Tax. They're nonpartisan, and basically what they score goes. So with respect to coming up with budgets that are revenue or bills that are revenue neutral, JCT scoring is the Bible, and it's what's followed. So this is just a quick glimpse of what came out so far from Ways and Means, and it's been scored objectively by JCT. There's three major components of the bill that are involving social spending agenda items, infrastructure financing, community development. So this is not the bricks and mortars piece of it, but it's ancillary to that. The subtitle G, the Green Bill, as some people call it the Green Bill. So a number of provisions around renewables and spending around those priorities. And then the largest component is the social safety net, which is the social infrastructure bill and the provisions related to additional programs to help folks out, childcare, free college tuition, those sorts of things kind of fit into that. And those are the spends. On the pay-fors so far, the Ways and Means Committee has inserted about $2 billion worth of, $2 trillion worth of pay-fors to cover the spending. And as you can see, as the Ways and Means bill is constructed, it actually not only pays for itself, but over a 10-year period, presumably would reduce our debt by a little less than $1 trillion. And again, these are trillions. So what's on the tax side of things? Here's a little bit of a breakdown. Big picture, your walk away is about 45% of the pay-fors are coming out of corporations. And that's broken down primarily in two areas: an increase in the corporate rate to 26.5%, a number of international provisions, mostly to raise the minimum tax on international sourced income to 15% through GILTI and FDII and a number of other rules. Lots of details here. And then a bunch of other corporate related items. About 45% is raised with respect to individuals, but really the bulk of it, I think, would apply to what I would consider to be business sourced income that's flowing through the individual regime. So pass-through companies that currently may enjoy a 28% rate could see a rate increase up to 44%, based on a combination of the individual rate, the net investment income surcharge on and limitations on QBI deductions for pass-throughs, limitations on NOL, and a surcharge tax on high income earners and trusts. So that's worth about $900 billion over 10 years. And then there's some taxes on nicotine, cigarettes, cigars, 10 billion, and a bunch of other stuff. So you got $2 trillion of total tax. So the big picture here is this thing's a pretty pervasive tax bill. And I would say that it's really a business tax bill, not an individual tax bill. Although they talk about it raising individual rates, a lot of what gets captured there, frankly, is business source income coming through on pass-throughs. As I said, the Senate has passed a bipartisan infrastructure bill, somewhere between, and I've heard $1.5 trillion. This slide says it's 550 billion, but I will say that that bill has some pay-fors in it, but because it's bipartisan, it doesn't have to be revenue neutral. So of the $1.5 trillion of spend, they got about a third of that covered in some taxes that aren't really income taxes, but other non-income related taxes to raise the revenue to cover some of that spend. So that's kind of an overview on sort of where we're at and sort of what's macro level, sort of where the tax policy topics and areas are coming from.
Mark, that is really incredible. And if no one has really kind of paid attention to the news lately, that is a great summary of where we stand right now. And to your point, you're mentioning this 550 billion being like that, or is it 1.5? Is it what is the number? It's because it's still evolving. So much is still evolving around all of this. So we've got to stay close to it, and we really appreciate the fact that we have you guys here to help us do that. So Mei Ling, take a look at this slide. These are some of the estimated economic impacts that are anticipated of what is to be. Walk us through this a little bit. How does all this tax regulation impact what are the estimated economic impacts of these regulations?
Sure, Sherry. Happy to do that. And thank you for the introduction and FEI for having me on this. And Mark has done a great job of walking us to how we got to this point. And so where we are currently with the House and the Ways and Means Committee is that there is going to be an increase in federal revenues over the next 10 years of about $2.1 trillion. That's a lot of money. And that's related to about 40 tax increases. So this is really going to impact folks all across the board. But it's not all about tax hikes. There's also about $1 trillion in tax credits. So make sure you talk to your tax professional about what those new credits may be and whether you may qualify regarding those. And then there's also $79 billion that's going to be invested in IRS enforcement, really to try to close that gap between the non-compliant tax, people who should be paying taxes and aren't. We really do feel, the government really does feel there's about over $100 billion that's lost every year because of non-compliance. So really this investment will really go a long way. So if you do the math at the end of the day, we're really talking about an estimated net increase of about $1 trillion, excluding the enforcement, which is really, I really, as a white collar attorney, I really hate to estimate what's going to come in with an enforcement action, but that's what's estimated with excluding the enforcement.
That is a huge number for an investment in tax enforcement. And where is that spend going? Is that in additional staff to go out and perform audits, or is that coming from someplace else? Do you have any kind of details on that?
Sure. So the details are obviously not clear to us yet. This is all in the works, and the nitty gritty is really going to be up to the departments, the IRS. But one of the really interesting proposals, and again, it's a proposal because they're still fighting about the details, is a proposal that was placed, that was made by the president with regards to IRS having access to information from accounts from folks who have more than $600 in deposits. And so that's really an attempt to really try to shed some more light into some of the opaque income sources that the government really feels like it's losing out in. Now, of course, Manchin and Senator Manchin and Senator Sinema are not too happy with this. It's extremely much more intrusive than we're used to. And so there's been a change. The counter proposal that's been floating around on the Hill is that number be increased from $600,000 to $600 of deposits all the way up. That threshold be increased all the way up to $100,000 of non-wage deposits. So really quite a change, and we really don't know where they're going to land yet, but really is something very different than what we've seen in the past with regards to enforcement, Sherry.
That's for sure. Thank you for that, Maylene. Very helpful. So we're going to take a little bit of a deeper dive now into some of the specific proposals that are embedded in this legislation. And we're going to start off with something pretty common to all of us, something that we can all kind of relate to, which is corporate tax rates. And we know that we saw a big change in that in the last few years. And now there is a proposal to kind of move that in a different direction with this new regulation. So John, tell me a little bit about this. This is out there. Clients obviously know this is out there. Yeah. And I'm sure your clients are already starting to make some plans around what they might do. What are you hearing your clients tell you that they're thinking about doing given this potential increase?
Yeah, no, thanks, Sherry, and thanks, FEI, for having me. So I would say first thing, most of my clients are talking to me and asking me, when are they going to get off the merry-go-round of tax reform changes that's been going on for the last few years? But ultimately, all jokes aside, I mean, we can all see what's going on with corporate tax rates. No one's talking about them going down. And, right now, a lot of the tax planning that we're doing is around what do you do in an increasing corporate tax environment. And, right now, what we're doing is we're advising our clients on some key issues. The first one is going to be, how do you think and look at your timing differences that you have, from a year end 2021 to 2022, and what can you do to potentially accelerate income into a 21% rate year when you're looking at maybe a benefit down the road at 28%. Or alternatively, you may want to look at your tax attributes, R&D credit carry forwards, NOL carry forwards, and look at maximizing items like that in order to benefit yourself down the road. Now, that's a simple, easy one. I know a lot of clients that I have are looking at that specifically and different tax methods they can employ and things they can do to accelerate income. Secondly, they're looking at their businesses. They're looking at their business decisions and their choices that they've made, and maybe figuring out ways that they can look to play within the changing tax rate structure down the road through transfer pricing and different planning mechanisms in order to get a better worldwide tax benefit to their organization. So those are two areas that we're looking at. And then, thirdly, I think what I've seen a lot of clients do, and this has been taking shape over the last 3 years, is they're looking really hard at automation and process improvement, because it makes it a lot easier for them to make these decisions and look at things real time in November and December, so they're not caught flat-footed when they need to get a tax provision prepared, they need to get through their regulatory filings, and those things are automated, which allows them, the convenience of being able to make real-time business and consulting decisions. So that's really what I see. It's those three areas that they're really focused on. And, really I would say the foundation for a lot of this that we're using is the modeling, which I know everyone's going to touch on, is modeling. The modeling that we've done with tax reform, using that, leveraging that and trying to take that and look at it under a little bit of a different skew, so we can plan better for the future. So that's what I'm seeing.
That is really good information. And I'm particularly interested in something that you said that I think some of our audience here today, because I know where some of them are working inside their organizations, when we think about some of that work you mentioned around automation and process improvements and all of that, we spend a lot of energy in that space. And a lot of times it's to bring visibility to cash, it's to bring visibility to income and all of that. But to the point that you're making here, it also has a huge implication on the tax arena, because in a situation where we don't know when this thing is going to hit and we don't know the timing of it, we don't know if there's retroactive provisioning of all of this, the ability to react quickly and to have data in front of you fast is going to be essential, right? And so I guess I'm wondering from that perspective, do you spend time advising your clients on that kind of work regularly? Not just when we have a moment like this, but it feels like this is just informing me for the first time probably that I've ever thought about it in a deep way, that kind of work is important, not just for normal visibility into kinds of things finance people care about, but tax folks need to see this stuff on a regular basis as well. And quickly.
Yeah, I mean, I think to the way I would think about it is the whole reason that we automate and have done so, and you can see it in sales tax, and you can see it in kind of how we pushed on the federal tax arena and the corporate space. I mean, you can just see how it mitigates risk. And what it does, it allows my clients and allows, people that are on this call to have a stronger, better conversation with your tax advisor that's getting to the heart of the matter. Because ultimately, as tax people, my view on it is ultimately we're trying to get down to a good question to have with a client, and a good question that's going to serve the best purpose. And so, the question of whether or not you have your calculations right doesn't serve the most purpose fundamentally when you're talking about a situation like this, but understanding, where you're at with, business decisions in your multinational organization is going to really help you significantly, especially when you want to talk about a situation we have today where, I mean, frankly, we don't know what's going to happen over the next 2 months. We don't know where we're going to be, but we got to plan for kind of both scenarios. And so automation is and knowledge gaining is really the best way for IC to make smarter decisions faster.
Exactly. I really, really appreciate that insight, John. That's really important. So I really want to have the problems that we're going to talk about next. I really want this to be a part of my problems in my personal life, but these proposals are not just going to affect our companies, but they're also going to affect us individually. And so we have a couple of slides here that talk a little bit about the impact, not only on income tax rates and things like that, but if you look ahead, it also looks at the fact that estates and trusts and estate planning could be impacted by some of these provisions. And so to the extent that we have clients that may need some advice on these topics, or if we ourselves need advice on these topics, Damien, what are you seeing out there? What are you advising your high net worth individual clients around this area of uncertainty?
Yeah, that's a great question, Sherry. And thank you as well for FEI for having me here today. Maybe I'll throw another element and go back to kind of what you and John were talking about of having this multi-year, look at things and kind of constantly be looking at this changing state. Because honestly, if there's been conversations in the last week or so with Arizona Senator Kyrsten Sinema basically vocalizing, I'm not on board with any that corporate rate increase or this individual increase, but maybe I'm on board with a 3% surtax. And then actually just this morning or late last night, depending on where you are, Senator Wyden introduced a billionaire's tax that was immediately rejected by Senator Manchin. So it's just such a tight squeeze that they're trying to go through. So, I mean, all of this is just in flux right now. So apparently the billionaire tax, if you want to call it that, or a mark to market, that's out. Maybe this is back in. It's very uncertain. But really, where I spend a lot of my time is the intersection of the business and the business ownership group. And a lot of our businesses that we work with are closely held, which means, any of the tax bill from the business lands on the ownership group. And so generally the way I would look at these individual changes, the way I'm talking about them is anybody with income below $400,000 in the year, these changes don't impact you, or they're designed not to. That was sort of a campaign promise of President Biden, and that's still sort of present here. So what we would see happen is essentially kind of an acceleration of what would happen if nothing happens in 2026, which is to mean that before that tax reform that Mark mentioned that happened in 2017, the tax rate, the highest marginal tax rate, that is, was 39.6% for individuals, went down to 37%. Well, we go back up to that 39.6 again, a little bit faster than we would ordinarily. It hits a few more people because it kicks in at a lower level than the top rate currently does. But that's kind of that in a nutshell. So again, if you're that pass-through business owner, rates would go up. Then there's this 3% surtax on incomes above $5 million. And the tricky part here is for those, if a lot of times when you have the business or investment assets or whatnot, you've maybe done some estate planning with trusts, or you have assets that are in taxable trusts. So these aren't the revocable trust or a living trust. These are the type of trusts that are tax paying trusts. This 3% surtax kicks in a whole heck of a lot earlier at $100,000 of income. So it basically means that these, when you have this income flowing through trust, it actually becomes more expensive to do so. So that, generally speaking, a couple other things really would basically mean for business owners in the ownership group that tax rates are going up. There's a few other things that layer onto it. So again, the top rate goes up. There's a 3% surtax if you're over $5 million. There's some changes to net investment income tax and qualified business income deduction, or the QBI. Actually, yeah, well, let's mention that while we're at it. Basically, right now, for example, an S corporation, that income that passes through the business is not subject to the self-employment tax right now. And so that's usually a strategy. You want to kind of leave some of that in there because you're able to shelter from what is effectively 3.8%. It's really 2.9% plus 9%. So it gets up to 3.8, which is the same as the net investment income tax. Well, what they would do under this proposal, and this one apparently is maybe not being looked at as a tax rate increase. So it would I guess Kyrsten Sinema would maybe be on board with this one. And just to back up, right, we have to get to 51 votes, even under budget reconciliation in the Senate. Right. It's a 50-50 split, so every senator's vote right now matters because presumably Vice President Kamala Harris will vote in favor of whatever we land on. But this net investment income tax may still be in there. Well, effectively, you'd have another 3.8%. So if you're an S corporation with income of, let's say, $6 million, the owner of it, right? So the top rate just went up 2.6% to 39.6. Then you're adding 3% on top of that as a surtax. Then you're adding another 3.8% on top of that, and possibly losing your 20% net qualified business income deduction. So all that to say, that's a lot of numbers, Sherry.
It is.
To paint this picture that tax rates are going up for small businesses, if again, what we're talking about is still at play, and maybe it's not because Kyrsten Sinema and Joe Manchin may not be on board with it. So that's kind of the conversation I've been having lately. And
it's another one of those we don't know yet kind of answers, right?
It is, but I think just to touch back to the point that John was making earlier too, and you were kind of touching on, right, is the fact that you really got to just kind of plan for the uncertainty.
That's right.
Run the numbers and look out multiple years. I mean, maybe it makes sense to go ahead and pull some triggers and lock some things in. These changes that we just talked about would be effective January 1, 2022. So you've got 2 months to play with here a little bit from a tax planning perspective. I wouldn't pull the trigger just yet because, like we said, maybe none of it happens at all. So you have to kind of look in the crystal ball there a little bit, but really kind of running the numbers, doing the math, thinking about what you maybe could accelerate or not accelerate. Again, back to John's point, I think is what I'd be doing right now, particularly as a business owner or an executive.
That sounds great. And Mark, I'm going to ask you a question about this. I know that FEI Chicago put out a survey on the pass-through entities, and we got some interesting outcomes as to, what our members were saying about how they would handle these proposals, if what we have proposed, if we would see in these proposals currently were to go through. What were some of the responses that our members provided as to their take on all of this?
Yeah, just following up on what Damian said, I think that the planning, is more complicated if you're a small business or pass-through, S Corp, LLC, partnership, than a C Corp. The C Corp, you're basically looking at a rate change. If you're international, there's going to be some additional provisions that affect rate, and it kind of the timing of income becomes a bigger issue. We're into the pass-through regime because the way our tax code is set up, there's really no distinction between business source income and earned income. If you're an owner of a partnership or an NA taxes a partnership, you have much more profound planning opportunities here. As Damian mentioned, some significant surcharges. If you are currently taking advantage of the 2017 Tax Act benefits that did benefit pass-through entities, you're paying about a 28% rate on your business source income that flows through on your personal tax return if you're ownership of a pass-through. Under the proposals that Damian reviewed, the tax rate on that business source income is going to go up to 44%. So you're talking about a material increase in taxes owed on the same amount of business income if you're in the pass-through regime. So as you think about planning opportunities and the importance of understanding what these imply, I think you got a lot more planning opportunities and a heck of a lot more decisions to make in a pass-through environment than you do in a corporate, because it's not just on timing. And as Damien mentioned, there is already a sunsetting in 2025 of what they call the QBI deduction that allows pass-throughs to get down from 37 to 28. So even if this law doesn't pass in its current form, and let's just say nothing gets passed, we still have that issue coming upon us. So, one of the questions we asked members in our survey in July, and this was before any of the details were known, but certainly a lot of chatter going on about what would happen. One of the most profound decisions that a pass-through has to make is, do I still want to remain taxed as a partnership? You can elect, if you're not a partnership, if you're an LLC or an S Corp, you can elect to be taxed as a corporation. So one of the early decisions and most important decisions are, do you want to change your form of ownership? And if you're looking at business source income at a 44% tax rate versus, say, 26, over the long run, that could be significant to your net cash flows, the ability to compete against C Corps that are in your same industry or international companies that you compete against. And depending upon your industry and your business, could be material to your ability to continue to reinvest in resources like people and or equipment and buildings and things and technology. Right. So that's a pretty important planning. I would say more than half of the respondents to the survey said that, based on what they knew and what heard at the time, that they would likely change their form of ownership if this is sort of where we ended up.
Interesting.
Yeah. So, pretty significant. And again, that decision also has consequences. If you do convert from a partnership to a C Corp, and let's just say you're a manufacturer, distributor on LIFO inventory accounting, and you've been on it for decades or years, you have recapture on that deferred income.
That's right.
You also have limitations if they come back in 3 years and change the tax code on us again, and say they reduce those rates on partnerships back down to the high 20s, and you're saying, hey, I kind of like being a partnership and I don't like sort of the rigmarole with corporations. Well, there's limitations on how many times you can change your form of ownership within a period of time, and there's also some negative implications when you go from a C corporation to a partnership tax through. So these are what I would call typically life event decisions, but because we're seeing changes and material changes in our tax code, particularly those that involve pass-throughs, they're creating some real. You have to have some really thoughtful and some simulation analysis and think about different options before you decide on what you want to do.
That all sounds so complex and challenging to sort out. And I'm going to ask one silly question from a brass tactics perspective. If it's December 31st at 11:59 p.m. and this regulation goes in and says, yep, we're gonna do this, and it's way more favorable to move to this form of ownership than the other, and folks want to make that change, can you literally make that change at that point? Is that a viable change? I'm going to ask that question first to Mark. Is it viable? And then Maylene, just tell me from your perspective, do you see that happening, and how do you advise clients from a legal perspective to do that the right way if they are doing that?
So I'll answer the first question. The good news is, if it comes down to a decision on whether you want to change from a partnership to a C Corp or vice versa, you typically have until you file the tax return for the year in which you're going to make that election to make that. So if the law changes on 12/31/2021 and say the effective rate goes up into mid-40s in your situation and you're in a partnership tax regime, you don't have to make that election right away. You can actually have some time. You have, in fact, I believe through all of next year and maybe through March or April 15th of the following year to actually make the election to change your form of taxation. So the good news, at least on that decision, you don't need make an immediate call on it. But
that's really good.
Yeah, but other provisions are a little bit more time sensitive. So I'll let Maylene kind of answer the second part of that question.
Yeah, so Mark, I think that's a really good answer, and I think from our perspective, what we were at is some of these the impact that some of these tax changes are going to have are going to be on things that you can't necessarily change overnight. So, for example, with a lot of the multinational companies, you can't necessarily pick up your plant or your headquarters and move it to another area because all of a sudden that's changed. So, but I think.
Oh, wait! You mean I can't just go get a PO box?
No. You're not supposed to do that, Sherry, right? But yeah, I mean that's the difficulty that we're having. But if you're in those discussions already, I think that the point is that if you're in those discussions already and you have a deal or operational change that you're looking to make, that you should really take these potential tax implications. And again, everything's sort of still up in the air. Take those into consideration and how they may impact your business moving forward next year.
I agree. And I'm going to make that recommendation that everyone consult your attorneys, consult your auditors, your tax providers when you're making these changes, because these rules are going to be complicated to sort out in short order. Something we think about fairly regularly, all of us face the words capital gains. I feel like that's been in the news for a decade or more, as it's been on that merry-go-round we were talking about earlier, John. And so I would love to know, Damien and John, both of you, I'll start with John. On the corporate side, what kinds of things are we thinking are going to happen with capital gains as we look at the proposal, and what can organizations do to help plan for that?
Yeah, no, thanks again, Sherry. I think, when you look at the capital gains tax changes, and I know this, falls a little bit more in the individual wheelhouse of Damien, but, I'll start it off. I think a little bit about some of what Mark was saying and some of the entity kind of decisions that you have going on. And so if I look back to 2017 and I think about how, a lot of pass-through entities started becoming C Corps, in order to take advantage of the lower rates. And I look, going forward, I'm thinking to myself, we likely have a situation now where maybe you have C Corps that are going to flip back into pass-through entities. So from my point of view, just looking at large corporate organizations, I see, maybe a review of your EMP, which would be your corporate earnings and profits, which is going to get dividend treatment, when you distribute it from your corporation. And so you may look at that and say, how can I take advantage of that at a current tax rate? Now, the big question underlying the whole thing, which I know Damien is going to touch on, is when do the capital gains tax increases go into effect, and how does that impact you on an individual basis?
So, Damien?
I hate to say it, I don't really know, but I do think you're going to see a flurry of, in my opinion, corporate activity on the M&A space, private equity space, just trying to maybe squeak in those capital gains rates, hoping that they're going to stay in effect through the end of this year. But right now, I mean, under both proposals, it looks like they're retroactive, but I'll pass it off.
Yeah. Damien, what do you think?
Yeah, I agree, John. I think, so the interesting thing that they tend to do whenever they talk about introducing tax, because that's really what it was. It was a markup that was released on September 13th, this Ways and Means proposals we're talking about. I mean, it was approved by the Ways and Means Committee on September 15th, unamended. So, it has gotten that far, and it's currently sitting with, they're trying to assemble the package if they can get to the same top line number. But what they tend to do is to try to not disrupt capital markets. So they'll peg it to the date that they released the text. So September 13th wasn't really a magic date, other than that was the date that they released these proposals. And it would have been effective for anything, from September 14th forward. So, if the proposal sticks and ultimately what would probably happen is the Senate Finance Committee or there'll be text that'll be brought up in the Senate Finance Committee. Maybe that's, we'll say hypothetically November 5th. Or something, and then the date changes to that. But if they're going to change the capital gains rate, the thought would be that it would be something other than January 1 because of the fact that, if you knew that on January 1 the capital gains rate was going up, well, then maybe you'd go and sell all that Apple stock that you have this giant capital gain on to try and lock in the lower rates. They don't want to do that ideally, and that's where this comes into play. So what I can tell you is originally we were talking about it going back to April 28th or the end of April, because that was when President Biden originally released the American Families Plan bullet points. I think that's off the table. Really at this point in time. I mean, it's hard as it is to say anything's off the table. I think that idea is dead. I don't think that happens. Could it be September 14th and already happened? Yeah, possibly. I think as the further the conversation's going, the further it gets pushed back, the more likely that day gets pushed back as well. Right. But even if it sticks at that September 14th date, you say, well, okay, well, maybe it's already gone up by 5% for me. Well, remember, there's that 3% surtax on incomes over 5 million. Mm-hmm. So maybe if you're looking at pulling the trigger on a transaction, doing so before the end of the year might be beneficial, because that 3% wouldn't, as written, go into effect until January 1. So maybe it's not 20% anymore, but at least it's not 28%,
right.
25. So I think there's gonna be a lot of activity. What I'm generally hearing, and maybe to go back again, great points that have been making here about, just planning for things and even choice of entity. You really have to have all this stuff lined up in advance. I mean, I'm hearing right now to do due diligence. It's incredibly difficult to find folks to be able to do due diligence, or your M&A attorney or your estate planning attorney. You've really got to get things into motion. And maybe it's not going to get done at this point in time. Maybe there's just not enough time on the clock, even if you wanted to. So I think time is of the essence, and really just doing that advanced planning is the key. And just doing that way you can make the most informed decision when things start to come in a little bit more clarity.
That's right. And, Damian, you, John, myself, Maylene, we've all, and Mark, we've had some chances to chat before this. And one of the things that you all mentioned that I thought was really important to your point here, this is happening quickly. It's evolving, it's changing, but this isn't the first time. We had a dress rehearsal for some of this back just a few years ago when we had the last tax changes in 2017. And so there was some homework done at that point that you guys mentioned at that point, and some of the things we took stock of, some of that due diligence that would have to be done then, that people should start to feel like they can start to pull that back out to reevaluate it under this new scenario, correct?
I would say yes, because in particular, maybe around that choice of entity conversation, the equalizer, because you look and say on the surface, well, the tax rate on the corporate side is so much lower. Well, wouldn't I rather be over there? Well, the thing that comes with C corporations is a second layer of tax, and so the capital gains rate comes into play. So maybe it's 26.5%, but if you're going to sell or you're going to take a dividend out, a qualified dividend, well, maybe that rate just went up to 25%. So you're stacking 26 plus 25. And that's sort of, an exit event is generally the equalizer on an exit. But you maybe already did that that work, like you said, dust it off from 3 years ago and look at it again, because if the rates do change, you kind of drop those in and see how it goes. It's a tricky analysis, but that's really great advice, is to go back and look at whatever you did before. Maybe things have changed, maybe they haven't, maybe you need to reverse course on some things. Maybe you don't. It depends is probably the best way to summarize it, Sherry.
It depends. Great answers, right? We have so many topics, guys, around the things that are in these proposals. And we're going to take a couple more of these, and then I'm going to kind of flip to a couple of other things really quickly. But I do want to cover this one more tax proposal item on small business stock. And Damian, I think that Section 1202 is something that you can talk to us about a little bit about as it relates to this provision specifically.
Yeah, it's a really powerful provision where you're able to exclude really up to almost 100% of gain sometimes if you have stock that is qualified small business stock, and there's a lot of pieces to it, but generally speaking, when capital gains rates go up, or if they would, 1202 becomes more attractive. Well, up until middle of September, they weren't talking about doing anything to this 1202. But for those that would have incomes over the 400,000, that same threshold, it wouldn't go away, but the 100% exclusion would get limited down to 50%. But what I'm going to do is, and this is one of my favorite parts about being a podcast host on taxes, is that what I'm going to say is if you want to know more, I will include a link to a recent episode that we had on the topic. So that way you can take the deeper dive, and I'll cede my time back to the discussion.
I love it. I think that's awesome. So are you going to throw that into the chat? I
just did. There you go. It's episode 132 of our podcast.
Outstanding. Outstanding, guys. You're getting it live, like happening now. So this is great from the experts. Fantastic. So as I mentioned, there are topics galore going on here, and there's a couple of others here that we could go into, but in the interest of time, there's just so much to cover. These slides are going to be made available to you, and you'll have an opportunity to sift through them. We'll have contact information for the folks that are joining us on this panel discussion so that you can reach out as you need to. So I'm going to go past this because I actually want to get to this guy here. And Damien, I think, I have to call on you one more time. But gosh, many of us are sitting here going, whoa, what's going on with this? This is going to be relevant for a lot of people that are on this call today, in this meeting today. Tell us, what provisions should we be paying attention to that affect retirement planning and retirement income?
Yeah, I would summarize kind of what the proposals are here to say that, it's targeted at those that have these really giant IRAs or Roth IRAs. Over the summer, there was a ProPublica piece around the $5 trillion, or it says $5 billion. It's still big, but not $5 trillion. $5 billion Roth IRA and the like. And so basically, they'd be putting a provision that would require mandatory distributions when your income was over, again, that $400,000 threshold, and you had a balance over 10 million in your Roth IRA. It was or any IRAs, basically. You'd have to start taking them out. So you can end up in the situations where if you have large IRA balances, maybe they have to come out and get taxed at the current rate. There wouldn't be a penalty, even if you're below the 59.5. But it would also shut the door on something popularly known as the backdoor Roth IRA. Conversions from, say, a qualified plan, so a 401k to a Roth IRA, that would go off the table. Interestingly, not until 2031, has a different effective date. But it would also prohibit things as to what you can have inside of your IRA, most generally around these, basically those where you have to have qualified investor status to be able to get to them. You'd have to get them out over a 2-year window, which actually probably creates a little bit of an investment challenge because a lot of times there's lockups on these things and you can't exactly liquidate them very easily. But the bottom line is they're really kind of targeting these larger deferral mechanisms and making people take them out, whether they're Roth or traditional in nature. So something to watch for, particularly if, like, for example, you have somebody has an ESOP owned company. Those are qualified planned assets.
Right.
And sometimes if the company does very well, or there's a liquidation event, there you end up with large balances in IRAs or 401ks, and this provision would essentially require those amounts to come out of the account.
Outstanding. Really, really appreciate it. We have, again, so many things that we can cover on here, and I'm just going to go through a handful of these and skip past a few slides just so you know what's kind of baked into the deck here that you're going to be receiving. We've covered some of these topics in some of the other conversations, and I think we've done a fairly good job talking about our estate planning and that sort of thing, so I'm not going to go into further detail on that one at all. But what I wanted to come to here is this. So, Mei-Ling, gosh, we do have companies represented in our FEI community and some of our guests who may be with us today that work in an international and multinational space. And there are provisions that are going to affect those entities. And I'm hoping that you can give us a little bit of insight on some of the things that we should be paying attention to for multinationals.
Sure, Sherry, and thank you for that. I think this is going to be really key for multinationals, and I really think that this is a product of this tension that we're seeing with the moderates who are not so pleased about raising taxes to no ends, right? So we have a lot of this coming out of Senator Sinema, who's saying let's find other ways to make up this revenue. So one of the big changes that we'll see is a change to GILTI, which is the global intangible low taxed income. And the bill that's proposed currently is going to reduce the deduction that's allowed to 37.5%, which is going to cause an effective tax rate of 16.5%. But what's also really interesting here is that this deduction is going to now be calculated on a country by country basis. So it's going to eliminate the ability of U.S. shareholders to blend their high tax GILTIs against their low tax GILTIs to really get a benefit. So that's going to go away. The other big one that I wanted to highlight on the slide, and I know we're running tight on time, so I'll be quick with this one, is changes to the foreign-derived intangible income. The bill also proposes a reduction of the FDI from 37.5% to 21.85%. There's a few other miscellaneous reductions and limits on deductions and allowances. For example, the allowance to allow a loss carry forward for 5 years and is now disallowing a loss carry back. So those are some other things that you should really keep in mind if you're a multinational corporation.
These are really, really important changes. And, as finance folks, one of the things we spend an enormous amount of time on, and the word was used earlier, is modeling and trying to put our what ifs and our scenarios into a view that provides a forecast for the future. And these are things that one of the challenges that we face with this particular provision right now, as we do, I suppose, with any provision like this, is that we haven't gotten to the end of it. We don't know what the scenario is. We probably have about 4 or 5 different scenarios that there could be, but it's on us to try to figure out what those are and start to model what some of these outcomes are so we can give the best advice to our partners and constituents within the organizations that we serve and with our clients that we serve, for those of us serving clients. So I can't begin to talk about how important this is and how timely it is and how good this information is. I hope everyone's soaking it in. And I want to encourage everyone to put all your questions into the chat. If you have any, we're going to be opening up for questions pretty soon. But any you want to ask along the way are welcomed as well. That said, Ways and Means Committee isn't perfect. And so here are some omissions that were mentioned or that we wanted to put on the slide. But there are other omissions as well that Mei-Ling wanted to raise. And so Mei-Ling, I would hope that you could take us through the ones that are included, that are called out, but also there's another one that you mentioned that we should also bring to bear. And it's on a topic that is near and dear to this group's heart, actually, on crypto.
Yes, for sure, Sherry. So some of the omissions is that there is they eliminate the cap on the SALT deductions. Those are going to stay in place. And there's also the carbon tax and the carbon polluter import fee. Those are going to stay in place. But the other omission, which I thought was notable from the proposal, is that there was going to be no changes on crypto, how crypto is dealt with and income from crypto. So those should continue to be reported as capital gains when they are realized. But I'll add a caveat to that, because as I remember from the top of the presentation, we also saw a lot of increase in resources and for enforcement. So as we've seen, crypto's really come under the radar, and they're laser focused on trying to find folks who have huge realization and gains with crypto and really trying to bring those into compliance. So just because there isn't a change here on how it's dealt with doesn't mean you should go, if you're realizing huge crypto gains, that you can go to bed early. I mean, go to bed easily because there's still there's this enforcement increase.
Fantastic. I'd be curious to know, and folks can put this in the chat if they are. If there's anyone here that whose organization is doing a lot of transaction work in crypto, and what the impact is, if they're anticipating what they've seen, any things they've been talking about in that space, I'd love to hear from you for this session. So feel free to share that with us in the chat, and we'll come back to you later. So that said, what is this all about at the end of the day? I think I'm going to ask John, maybe for from a corporate perspective, a sort of a summary by the numbers perspective. What are your strategies that you're saying everyone should take care of? And then I'm going to go from John. I'd like to go to Damien. What are the strategies and planning things you're advising? Then I'd like to go to Mei-Ling. What are some of the things you would suggest that our clients are doing, that our companies are doing, our mid-market companies in particular? What advice would you like to offer? And then we're going to have a little conversation with Mark from an FEI perspective about some of the advocacy work going on. So John, give us a sort of summary from your perspective. What ought we be paying attention to? Your advice.
Okay. Yeah, no, I appreciate it. Thank you. I like to kind of simplify things usually when I talk to my clients because it helps. And so the way I'm looking at things right now is I think we have to figure out what we know, which I would say is kind of, and when we've alluded to it, there are some changes that are coming due to Tax Reform 1.0, 2017. There's changes to the interest deduction cap. There's changes that are coming down the road, just the way we're losing the QBI. There's a lot of changes that are happening without Tax Reform 2.0 that we're discussing here. So we need to look at what we know. We need to look at the rates and how they are changing, independently. We have, and without Tax Reform, we have changes in the interest limitation calculation for corporations. We have changes in Section 174 costs. We have changes that are going to be coming through and impacting corporations. Then I want to talk about the next thing is what do we want to plan for that we don't know? Well, we don't know how tax reform is going to hit, but we need to plan for it. So we take what we know, then we figure out how it layers into a model that we work with and we know and we plan for. So we need to think about, what do we want to do about increasing tax rates? What ways could we actually save ourselves some money? Are we ever going to take a distribution out of our corporation? How do we want to look at that? Should we do it today? And what does that time value of money mean to me versus tax today, tax tomorrow? And then the biggest thing is to layer it all into a business decision, because tax, as much as we like it to in our universe, it's the tax tail and it should never wag the dog. So ultimately, the business needs to make a decision as to what they want to be, how they want to evolve. And so we try to layer kind of those facts within a broader discussion about where you're going to be. I think as Damien's alluded to, and we've talked about, where's your business going to be in 2 years, 3 years, 5 years? Are you going to be retired? What's your exit strategy? Do you have an existing C Corp? What's the structure and what's the ownership of that C Corp? And how can we take that ownership and maybe evolve it to a better model if there is tax reform? And so for me, I look at it and say, okay, well, there's a lot of things we know, and we can use that to kind of start thinking about what we don't know and what people are saying, because we don't necessarily know specifically what's going to happen, but we have a general sense that, rates kind of feel like they're going up. And that's the way I like to look at it. And as I think, as everyone said, you start that discussion with your tax advisor, look at the models you've done, and then start, playing with kind of maybe a new base case, a new threshold going forward, and then start thinking and planning. So that's kind of my take on the whole process, and consult your tax advisor in here.
Consult your tax advisor, because my brain hurts when I think of it on my own, for sure. So, I'm also a big proponent of this concept, which is brilliance is often not measured by the things people know, but by the questions that they ask. And you've posed some really great questions that I think our finance folks here should be asking about all of this. And that's what they need to bring back to their organizations and start to plan for. So I really appreciate that, John. Damien, how about you? Wrap us up with your thoughts about what should we be thinking about from your vantage point?
Absolutely. Yeah. Great questions there, John. I agree. So everything he said, I'll take the lens of the estate and succession planning consideration in here, because I know obviously as you look as the financial executive, you're helping the ownership group kind of manage returns and what it means to the family, manage maybe succession, particularly when it's closely held and you have a family or family-owned context. And, we touched on it briefly, but the fact that, if you are subject to the estate tax now, or if you have an ownership group that is, there's going to be a lot more people that will be subject to it potentially if they enact what they're talking about. There will also be a lot more that will be subject to it after 2025 because of the sunset of a provision under the Tax Cuts and Jobs Act or 2017 tax reform. But there's some proposals in there related to grantor trusts. It's very complex and convoluted. So it won't go too far down that road, but just to say that there are some things that you can do today that you might not be able to do from an estate planning perspective, from a succession planning perspective, after the date that President Biden would sign this bill, should it all come together and it get to that point. So let's just say hypothetically he signs it the day before Thanksgiving. Well, then these grantor trust provisions kick into play if they're still included, and you wouldn't be able to do it. So basically, as I say, right now, if there's a succession on the horizon, event on the horizon, or there's a need to maybe plan for estate tax. I mean, estate tax, if it comes into play, it's not as many people are subject to it as they used to. And the reason is the lifetime exemption is so high right now. Essentially, a married couple has a little shy of $24 million that they can give away during their life or at death and not have to face federal estate tax. The Illinois estate tax number kicks in at a much lower number. But in any event, I mean, that can have a very big liquidity pull or create some a need that can impact the company, regardless of the form of the company. This, what type of structure it is. So really, the estate tax and knowing where the ownership group is, or if you are the owner, where you are, being able to help the ownership group navigate that and at least have those conversations. There's a lot more you can do if you start that conversation right now than you would be able to do potentially if this were enacted and move forward. So what I'm sort of saying is, when it comes to estate planning, succession planning, because of capital gains and the like, maybe run but don't walk. To start to talk to your tax advisor, but don't do it in a vacuum. Tax advisor, the legal advisor, it takes the entire team. Financial advisor, there's just so many people that come into play here. You really need kind of a team of advisors all talking together and considering all options. So yeah, run, don't walk is my talking point, Sherry.
I love it. And the day that I get to announce that I'm your client is a very happy day for me, Damian.
There you go.
Wonderful. Maylene, how about you? Wrap us up with some advice that you'd like to leave us with.
Sure. So I'll hit 2 points. One is with the multinational entities. I think, there's been a lot of talk in the news about a move towards a global minimum corporate tax rate. That's obviously not part of this proposal, and we're not going to get there before the end of the year. Stranger things have happened, but I'm pretty sure I can put a bet on that one. But I think regardless of that, I think we really, some of these things are going to happen, and we're talking about conversations around the fringes, right? So this change on the allowance on the GILTI deductions, those things are going to happen. So when you're planning ahead, you really need to, as a corporation, you really need to take stock of that and not make long-term decisions based on what's no longer going to be the tax implications when that's changing and the environment is generally changing. And then my second point is really on enforcement. And here's one where there is time, right? Because if you've been taking very liberal decisions on what you consider to be income, because you think the IRS is not going to find you, if you're not reporting your crypto because you don't think the IRS has the resources to locate that, you really should really reconsider that. And based on the fact that we're increasing, that this bill proposes an increase in the resources that are going to be invested for enforcement, and just generally because of this, and because of this other proposal, which probably will be part of the bill in one way or another, which is highly intrusive, which allows the IRS access to bank accounts wherever there's deposits. The threshold is still under negotiation, but whenever there's significant deposits in that account. So based on those two things, right, enforcement, I think, is obviously going to move up. And so folks still have time to kind of consider and seek advice. And if before they're under the specter of the IRS, and really make use of self-disclosure programs, or even amending prior tax returns to the extent that that's a viable option. But really, now's the time to make those decisions. You're still in time.
That is a really great piece of advice, Mei-Ling, and I appreciate you raising all of those things. I found it interesting you talk about the self-disclosure programs, which I didn't know there were such things, but I would imagine that that's going to be something people should pay attention to as well, because you're right. Things get messy from time to time. We don't always know exactly if we're doing things exactly the right way all the time. So really good information. I am going to, I put up a few slides as folks were sharing that I hope you were able to absorb a little bit of here. But what I'd like to move into now is just giving Mark an opportunity to talk a little bit about FEI's advocacy work around this topic, as well as just in general, some of the kinds of things FEI has been doing. Our members certainly rely on us for this work, and we're really lucky to have Mark here to talk a little bit about how we have been engaged in this process. So Mark?
Sure thing. Thank you, Sherry. So as a benefit to members through the national organization, FEI maintains a number of advocacy committees. There are two that have really focused in on tax. There's a committee on tax, which is really composed of the large publics and multinational corporations. They generally interface with Treasury, the legislative branch, and other trade groups around issues mostly centered around multinational. The committee's nonpartisan, as is the private company committee, but it's largely there to provide advice, consent, and have dialogue with policymakers on matters of tax and public interest that involve large publics and multinational in particular. The private company committee, we have several subgroups. Arlene Schwartz currently chairs the group. I run a succession planning subcommittee. Mike Adhikari, Chicago member, also on the call. Mike works on our capital markets and private equity component, and Tim Anglem out of a New Jersey chapter runs a special interest group for administrative and legislative. Collectively, we sort of manage the policy aspects, along with Todd Horsanger out of our Minneapolis chapter, who's really our international tax expert. I would say a large amount of our activities, and I've been involved with private companies since it was formed more than 15 years ago at FEI, has impacted legislative outreach, and a lot of it's been around tax policy. We've met regularly with legislators, their staffs, Ways and Means, Senate Finance, Treasury, on proposed legislation that involves privately held companies. Again, a lot of it with a bent towards tax and tax policy. We provide position papers to these groups. We also sign on to position papers by other trade groups, mostly the S Corp group and the National Institute of Family Business, which are two of the larger kind of organizations that are non-trade organizations, but ones that are in this private company and pass-through space. And then we've also provided oral and written testimony both to Congress as well as to Treasury, and help them form their thoughts about what legislation should look like in the case of Treasury rules. So we're actually quite active. We've been doing this for several administrations. We were quite active in 2017, and just to kind of, again, a little background, in 2017 the main issue was corporate competitiveness. We had corporate rates of about 34%. We were losing business overseas. We had corporate headquarters moving overseas, inversions going on. And there was really a big, concern. So and in fact, at the time, 34% put us as an outlier with respect to international corporate tax rates. So we moved that down to 21%. Where we got involved, frankly, was the parity issue. So we had at that time, before 2017, we had a 34 corporate rate. Pass-through entities were going through the individual regime, which was either 39 or 37, depending on which version of individual tax we were on. So things were fairly consistent. And of course, pass-throughs had the advantage of one layer of tax. Well, when they moved the corporates down to 21, you created a significant gap. We were very active and I would say influential in helping shape the thought around getting this QBI concept in which we had pass-throughs, the ability for qualified pass-throughs with enough payroll and in the right sorts of businesses and industries to pay a 28% on their business source income, so that there was more or less a reasonable parity between companies that were earning income on their business activities that were in a C Corp and those that were in a pass-through. I would say that the difference this time, and we were on the Hill virtually earlier this year as some of the new Congress got it in place. We met with Andy Grossman, who's the head of Ways and Means. We met with the lead staffers for Wyden on Senate Finance. This bill's a little bit different in that it's primarily, a spending package which needs taxes to pay for it to get through, a vote. And so, as John said, clearly the direction is increasing rates, collect more taxes from corporations, from individuals, pass through entities. So really, a lot of our activity has been around trying to, trying to educate consequences, because there are consequences to this activity. If you're a pass-through and you're going from 28 to 45%, maybe you're not a pass-through anymore. And then maybe you're in a corporate regime and your taxes are going to be 26%. And guess what? We're not going to collect the money that the JCT thinks we're going to collect. Or in the case of international, you have choices on where you can put your business. And you can shop around even with a minimum 15%, worldwide tax regime, if that really is, something that passes. You can start thinking about offshoring income or shifting income around outside the United States, which has an impact on revenue. So what we've been working on, is trying to educate and propagating, principles that we feel are, principles that we would hope the legislative branch would adopt, and principles like, we believe that business sourced income should be taxed, consistently, regardless of the form of ownership. And again, a principle. So having a gap of 15 to 20% in tax rates just because you own a company outright in a partnership form versus having a C Corp, it doesn't seem to make sense from a competitive perspective, from the perspective of net operating or net after-tax cash flows that you get to retain. Also, with respect to capital gains, again, a lot of talk about capital gains. And I'd say generally the sense of capital gains is, we think about, people making a lot of money on the stock market and on investing activity. Well, our position is there's really a couple different kinds of investing activity. If you're an owner of a company and you've put money into a company, you've built it, from a garage to Microsoft, we think that's kind of a different sort of equity than if you bought and traded stocks on the open market, where you really are a passive a passive or a trading activity. So some of the things we've tried to, influence is to think about, again, the impacts of some of the proposals when you sort of put a broad brush over all capital gains, and then you start reaching into transactions, as Damien said, lifetime transactions of company owners who make a lot of money at one point in time in their life when they sell their business. And all of a sudden they're paying a huge whopping, capital gains tax, and they're treated the same as somebody who's making money trading in Robinhood every day on an investing type of capital gain. And we think there's a difference there. And so, from our advocacy perspective, we try to promote principles, and then certainly we try to offer proposals on alternative proposals to the legislative branch to achieve their objective in raising revenue, but in a way that we think is maybe more fair and maybe less consequential to pass-throughs and closely held businesses.
Mark, I feel 1,000% smarter just listening to you talk about all of this. And I appreciate the work that you're doing deeply. I'm going to offer this and definitely will reach out to you. As chair of the Chicago chapter's communications committee, if there are things that we need to be communicating out on, that we need to be sharing, that we need to get feedback on, and that sort of thing, I would love to be able to help with some of that, because directionally, I'm enjoying the learning that comes out of the work that you're doing, and I want to make sure that our members are aware of this work. So I'll reach out to you for that. I'm sure the folks that have joined us today have benefited from hearing all of that as well. Thank you so much. Folks, we are going to ask if you have any questions at this point. I didn't see any things come up in the chat just yet. Thank you. Yes, Ron, that is indeed. Let's see, we do have one question that just showed up. I'm going to read this question for the group. If the IRS is authorized to require banks to provide detailed information for people who have deposits over $600 or over $10,000, will this require a bank to upload all bank account transactions, both debits and credits, or only those which are on an individual basis over $600 or over $10,000? I'm not sure who the right person is to answer that question, actually.
I'm happy to take a first stab at it. Yeah, it kind of falls within the enforcement regime, so happy to take a stab at that. So the two thresholds which are being discussed, Biden's is $600,000, and then it was moved up to $100,000 under the senator's proposals. So I think there's going to be a lot less people that fall under the $100,000 a month proposal, especially because they're excluding the $100,000 is directly tied to like a direct deposit or a wage. So that limits the universe. And then we don't know the details. It's part of the problem, right? Because the language that's being used right now is the IRS will have access to bank account information. Now, this is going to be in addition to the SARs and the CTRs that the banks are already required to file under the BSA, the Bank Secrecy Act, and other anti-money laundering requirements. So we don't exactly know what information is going to be shared. They have made representations that they don't think that this kind of sharing will increase the number of audits for the lower income folks. Well, obviously, because $100,000 a month is not something that lower income folks are going to be coming into contact with on a regular basis. So we don't know, but it is, again, if you're in touch with an advocacy group like FEI, you might want to talk to them about how do we get more information, and how do you reach out to folks and make sure that you're getting all the nitty gritty facts on these proposals before they're being passed. But yes.
Outstanding. Thank you, Mei-Ling. Don't we have the great group here, guys? I'm just in awe of this panel. They are amazing. We have another question out here. Is there still talk about retro effect on the changes in the tax rates? And I'm gonna put that out there for John. I think we were just talking about this the other day.
I mean, right now, I believe the only thing that they're looking at for retro changes is the capital gains. They initially talked about it, but in my experience, most of the time when you're running for re-election, you don't want the rate increases to take effect until after the midterm election. So it helps everybody out a lot if the rate changes take effect in 2022 and then you aren't paying those taxes until later. That's just my interpretation. I think, Damien, I'm not sure if you have another one, but that's the way I'm seeing it.
I agree with you. And I think a lot of this all goes back to the 2022 election and people feeling it before that. Everyone wants to keep their jobs in Washington. And so having it happen after, and even just trying the pressure to get it done. I mean, I think that's why there's a lot of people that say, well, is everything out the window? I mean, it seems like they're kind of far apart. Can they get there? Well, I think there's sort of this feel that they got to get something done. Right. So we'll maybe likely see something because of the pressure of the election. But yeah, I think it's still a possibility. You can't rule it out, but it does become less and less likely as they start to get closer and closer.
Got it. Beautiful. And thank you, Michael, for your comment. It's much appreciated. And then Todd has a question for us. Mark, first, a great presentation on CPC, and I agree with you, Todd. Any thoughts or updates on double death tax or grantor trust proposals?
I guess I'll give my thoughts on this one. On the grantor trust proposals, I think there's not a lot of revenue, I guess, if in the scheme of things of what's raised for. I think the JCT scored it at about $8 billion that would raise, but it's not really a rate increase. So Senator, I don't know where Senator Sinema stands on it, or Senator Manchin stands on it, but I think that's palatable. And sounds like particularly, so if there's something called an irrevocable life insurance trust that allows you to take life insurance and essentially get it outside of your estate. So it's not subject to estate tax. Well, that's a type of grantor trust. And, that would not work after this provision would go into effect, if it did go into effect. So there's a whole lot of lobbying going on by the insurance industry. Now, that said, I don't know how effective that is. I mean, they're going to need to have revenue to balance this out, as Mark was pointing out. So as much as I'm not really a fan of it, I guess, from the fact that it really limits what you can do from an estate planning perspective, those grantor trust provisions, I think, may have some staying power. But again, that's just my personal guess. I don't know. The double death tax, I guess we're looking at maybe the step up in basis rules. I think step up in basis is out. I know they don't have the votes for that. And they kind of pulled that, and that's when they pulled in these grantor trust provisions to kind of replace it in the House Ways and Means version. And again, mentioning kind of this wealth tax, which sort of works like that base, getting rid of the step up in basis. That was being proposed in the president's Green Book proposal. And thank you, Sherry. Yeah, pull
absolutely.
Up here. It's similar, I guess you should say, because it accelerates these gains that otherwise would get, get that step up in basis. But yeah, I think the step up in basis is effectively dead. That's not going to get through, and they've kind of moved on from that. So maybe some good news there.
Yeah, I think we just got to keep our eye on it. These two items are basically been commonly used for decades in order to ensure smooth transition of family and closely owned businesses from generation to generation. And I think that's sort of the important point here, right? And whether you own a family farm, which certainly would come under this, or you own a business and you've got assets and you've got employees, and the wealth of your estate is tied into illiquid business. These techniques are generally been used in the past to provide orderly transition of business, so that you don't have disruptions and the need to liquidate or overburden the business with debt just because of the death of an owner. So while they may be relatively small in terms of revenue raised, they could be actually quite impactful with respect to employment and economic activity in the closely held sector. And again, about half of our business source income in the U.S. is coming from closely held. So at some point in time, would affect very many large businesses. So again, these are things that we keep an eye on. We actually offer what we hope are reasonable and sound proposals to ensure business continuity while trying to provide a level of fairness, which I think is that taxes are paid when they're owed. And I think generally, we're all CFOs and financial people here. Generally, when there's a transaction, we generally don't think death or mark to market creates a transaction when there's no boot involved, kind of accounting 101. So, we work on it. I will say that a lot of what we do is educating legislators, and especially those that are in Senate Finance and Ways and Means. A lot of them don't understand this. And so they look to the members in those committees to tell them what to do. And, and oftentimes they don't necessarily have the perspective. So it's one of the things we do with advocacy is try to touch the members and keep them informed and let them know what the potential consequences and alternatives are. So.
And folks, we are coming up on time, but one shameless plug, FEI is certainly always looking for new members and looking for folks who want to serve on committees. And Mike has put a comment out here. It's open to everyone. So please contact Brian Cove if you're interested. His name will be inside the deck that will circulate. We have time for just one more question. If we can hang on just a moment, I want to get Gordon's question answered. will brokers have to report qualified dividends pre and post September since they're taxed at capital gains rates? Who has insight on that question? Anyone?
I would say theoretically, yeah, they would have to it would have to get broken out, and it becomes very complicated to have a split year where you have the rate change mid-year on the capital gains transactions. But yeah, presumably there would be some reporting there. It's not entirely clear. I mean, either way, they'd have to report it, and it'll be up to the tax preparers to sort it all out, I suppose, on the other side. But I guess we'll have to see if that actually gets enacted, because that's always the tricky part, right? Is you enact the provision. Once they land on it, or assuming they do enact it, then it's, well, what does it mean and how do you implement it? And there'll be a lot more to come on that. I mean, we're still learning stuff about the 2017 tax reform that they implemented, right, Mark? And guidance we still don't have on some of that. So it's sort of a perpetual thing. So I think that would probably fall in that bucket of, we'll see. But practically speaking, yeah, we would need to bifurcate the two.
And that's where we have a second bite at the apple. Usually we get involved with Treasury when they're trying to form the rules. And that's another way that, we can influence the process.
Outstanding. Well, I think we're up on time, folks, and I'm going to turn it back over to Dan to close us out. And I want to thank everybody for attending. It's just been a really great session. I appreciate your questions, and I appreciate this panel particularly.
Thank you, Sherry, and thank you for moderating, and thank you to all the panelists. It's just a great program. A couple of reminders. We have our 10th anniversary Chicago CFO of the Year Awards taking place on November 18th. So we're really excited about that. Unfortunately, due to some COVID restrictions, invitation only, it's going to be limited in person. But we encourage everyone to view the live stream ceremony that we'll be having on FEI's YouTube channel from 7 to 8 p.m. So keep an eye out for details for that. It should be great. We have just a fantastic group of finalists. So we're really excited about that. Again, I would remind any guests that we have the 6-month trial membership. So take us up on that. Also, Susan will be distributing the feedback evaluation, so please take us up on that as well. And thank you again to all the sponsors of our chapter. We really appreciate that. And thank you for everyone attending, and have a great evening.